Enron had a problem. The problem wasn't that they were losing money. The problem was that everyone thought they were making it, and they needed to keep it that way. Let me take you back to 1985. There is a man named Kenneth Lay, and Kenneth has a vision. He wants to build the most powerful energy company in America, not just a company that pumps gas or runs power lines, a company that trades energy like a stock market, but for electricity and natural gas. He calls it Enron, and for a while, it works. Enron grows, revenues climb, Wall Street loves them. By the late 1990s, Enron is worth $70 billion. They are the seventh largest company in the entire United States. Fortune magazine names them the most innovative company in America, 6 years in a row. The stock price keeps going up. Investors keep buying. Employees put their entire retirement savings into Enron stock. Everyone wanted a piece of Enron, but here's the thing nobody knew. None of it was real. See, Enron had a problem that started small and grew into something they could never take back. Their actual business, the trading, the energy deals, was not nearly as profitable as they told everyone it was. The numbers were not adding up, so they needed to make the numbers add up a different way. Enter Jeffrey Skilling. Skilling is the kind of guy who walks into a room and makes everyone feel like they are the smartest person there. Sharp, confident, ruthless. He brings in a new accounting method called mark-to-market. Here is what that means in plain language. Normally, a company counts a profit when the money actually comes in. You sign a deal, you deliver the product, you get paid, you count it. Skilling said, no, we count the profit the moment we sign the deal, even if the money will not arrive for 10 years, even if the deal might never pay out at all. We count it today. The SEC approved it. It was technically legal, and it was the beginning of the end. Because once you can count money you have not made yet, you have a very powerful tool. You can make your company look like it is growing even when it is standing still. You sign a big deal. You book the profit immediately. Stock price goes up. Executives sell their shares at the peak. Then the deal quietly falls apart 2 years later, and nobody connects it back to that one quarter when the numbers looked great. But here's the problem with that game. You have to keep playing it. Every quarter, you need bigger numbers than the last quarter, which means you need bigger deals, which means the lies have to get bigger too. So they built what they called special purpose entities, SPEs. Think of them as secret compartments. Enron would take all of its debt, all the money it owed, all the deals that were going bad, and stuff it into these separate companies. Companies that existed on paper. Companies designed to keep the debt off Enron's official books so nobody could see how much trouble they were really in. The man in charge of building these secret compartments was Enron's chief financial officer, Andrew Fastow. And Fastow was not just hiding the debt, he was also paying himself to run the companies that were hiding it. He made $30 million personally from the scheme while Enron employees had no idea their company was a house of cards. Now you might be asking, how does nobody catch this? What about the auditors? What about the banks? What about the analysts on Wall Street whose entire job is to look at these numbers and tell people the truth? Here's where it gets dark. Enron's accounting firm was Arthur Andersen, one of the most respected firms in the world. They signed off on Enron's books every year. They were supposed to be the check, the safeguard. But Arthur Andersen was making $52 million a year from Enron. $27 million in auditing fees, another $25 million in consulting fees. When you are making $52 million a year from one client, you do not ask hard questions. The Wall Street analysts who covered Enron kept rating the stock a buy even as warning signs appeared because the banks they worked for were doing business with Enron, millions of dollars in deal fees. You do not bite the hand that feeds you. And the executives at the top, Lay, Skilling, Fastow, they kept selling their own shares while telling employees the stock was a great investment. In the year 2000, Kenneth Lay sold $70 million worth of his own Enron stock. He did not tell anyone. But something started to shift in 2001. A financial analyst named Bethany McLean wrote an article in Fortune magazine. The title was simple. Is Enron overpriced? She could not figure out how Enron actually made its money. She had read every filing, every report, every public document she could find. And the more she read, the less sense it made. Enron's response was to send 3 executives to her office, including Skilling himself, to explain it to her, to convince her she was missing something. She was not missing something. But the article did not bring the company down, not yet. What brought it down was a memo. In August 2001, an Enron executive named Sharon Watkins sent a letter directly to Kenneth Lay. She told him in plain language that the company was going to collapse in a wave of accounting scandals. She called out the SPEs. She called out Fastow. She said the whole thing was going to unravel. Lay's response was to have Enron's lawyers investigate whether he could legally fire her. He could not, so he did nothing. By the fall of 2001, the walls were coming down fast. In October, Enron announced a $618 million loss for the quarter. They also announced they were reducing shareholder equity by $1.2 billion. The stock started dropping. Then the SEC started asking questions. Then the real numbers started coming out, the debt that was hidden in those secret compartments, the profits that had been counted before they existed, the deals that never paid out. All of it started surfacing at once. The stock that had been trading at $90 a share in August 2000 hit $1 by November 2001. Employees who had their entire retirement savings in Enron stock, money they were not even allowed to sell during the lockdown period, watched it become worthless. People who had worked at Enron for 20 years lost everything. Their savings, their pensions, gone. In December 2001, Enron filed for bankruptcy. At the time, it was the largest corporate bankruptcy in American history. $74 billion in shareholder value. Gone. 20,000 employees. Their life savings gone. Now here's where justice gets complicated. Kenneth Lay and Jeffrey Skilling were both convicted of fraud and conspiracy in 2006. Skilling was sentenced to 24 years in prison. He was eventually released early after serving 12 years. Kenneth Lay was convicted on 6 counts of fraud and conspiracy. He was facing 45 years in prison. He died of a heart attack before he was sentenced. Andrew Fastow, the man who built the secret compartments and paid himself $30 million to run them, cooperated with prosecutors. He served 6 years. Arthur Andersen, the accounting firm that signed off on all of it for $52 million a year, was convicted of obstruction of justice for shredding Enron documents after the investigation began. The firm collapsed entirely. 85,000 people lost their jobs. Not because of what Enron did, because of what they helped Enron hide. Here's what the Enron story actually is. It is not a story about one evil man or one corrupt company. It is a story about what happens when an entire system, the executives, the accountants, the banks, the analysts, the regulators, all decide that looking the other way is more profitable than telling the truth. Every single person who was supposed to catch this chose not to, and 20,000 employees paid the price. Enron had a problem. They just made sure nobody knew about it until it was too late. If you want to see more stories like this, the real stories behind the biggest fortunes and the most spectacular collapses in history, subscribe to Wealth and Ruin. New video every week. Drop a comment below. Did you know how deep this scandal actually went? Because most people only know the name, not the story.